big market makes a new high after 15 years, that's something to pay attention to. Gold is less volatile than a treasury bond for the first time in 45 years. If you had to pick one sector that has the broadest bullish response in the market over the last 18 months,
understanding what's going to do well in 2026. We've got David Burrows on the show. He's a billion-dollar fund manager with a history of outperforming. His last set of top ideas are up 53%. And today we're going to find out what he's buying next.
a lot of these companies over the next many years are going to be 5 and 10 baggers.
Wow. The Sell America trade is alive in 2026. Can you insulate from the news if you want to continue to own those? Are you violating your own practices by owning CNQ? The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. I know, can you believe it's still early 2026 and so much has happened. So we do want to have a little bit of fun on the show. You guys know I love my swag, my EBITDA hat, my freak in the sheet mugs, my smells like a man in finance candle. I'm sort of running out of things to print off and put on stuff. And I know you guys are super creative, so we're going to kick things off for the next month. In the comments, wherever you're listening, Apple, Spotify, YouTube, drop in the comments what you think our next swag item could be. You guys are funny. You guys know finance. So I'm very excited to hear what creative ideas you might have. We're going to put it on a mug or we'll put it on a hat, whatever the winner is. And of course, we'll send it to you, the winner. So all month long, our swag competition. If you've got a funny idea for a finance meme, something you think would be great on a mug, comment wherever you're listening. Okay, on to today's episode. I'm super excited. We have David Burrows. He's the chairman and CIO of Barometer Capital. And he was on in March and sort of was really banging the table about the shift that was taking place in markets and really trying to shake people and say, stop obsessing over the Mag 7 and tech. You need to understand that other things are going to start to outperform, like materials, like industrials, like financials. And lo and behold, they did. So now we're going to find out what he's saying about 2026. As always, let's get into it. David Burrows, thank you so much for joining us again on the podcast.
So glad to be here, Amber.
So I don't know if you know this, but you were on in March of 2025, and we were just kind of getting our sea legs started as a podcast. And still, to this day, you have the most viral clip that we've ever had. Did you know that?
I had no idea.
I think it's something like, on Instagram alone, 350,000 views just on Instagram. And at that time, we had almost no followers. And I just want to play it for you just to refresh your memory and our audience on what you said.
Canada behaves a lot more like global markets than U.S. markets. Canada, by the way, has outperformed the U.S. market since June of this past year, despite all the worry about tariffs. The reason is that the sector makeup of the Canadian market is more like global stocks. Global markets are dominated by financials. Over 30% of the MSCI All World ex-US Index is financials. They trade at about half the multiple of US financials, by the way. And then you have materials and energy and industrials, a lot of industrials. Warren Buffett's been buying Japan for the last 3 years. He's been buying industrials and the trading companies or financials. He's not a dumb guy. So the reason that Canada behaves more like global stocks is our sector makeups are a lot more like we have a lower tech weight. European countries have 1, 2, 3, 4% technology. The rest is, industrials and financials and consumer discretionary. So Canada's actually set up quite well.
So Canada is actually set up quite well. You said that in March at a time where, we were elbows up against the US. I think that's part of why it went viral, right? Yeah. This whole Canada versus US theme. But the other part is it turned out to be incredibly correct. Canada did outperform. And you got us away from the news flow of what was driving that. So cut to today, where the news flow is crazy, and we're trying to understand what's going to outperform in 2026.
Yeah, it's really interesting. At the end of the day, it's about getting to the right neighborhood in the market. And the truth is, the things that are fueling the leadership right now are only getting stronger. So every country on earth is exercising fiscal stimulus. We have loose monetary policy everywhere. And so you can see the impact as it's washing through markets and things like commodities, where there's something that's scarce and protecting purchasing power. So I think this is going to continue. And I don't think just because we went through a new year, there's some new leadership. These are structural themes I think are going to go on for years.
So this idea that Canada gets caught up in that, it's not necessarily Canada per se, but in your original clip, you said Canada just is a global market. And so the US, so overweight on tech, maybe it doesn't have what it takes for the next couple of years. Help us understand what are the right neighborhoods right now.
Well, when structural change starts, it's a little spotty at first. And this took 2 or 3 years really to get going. But pretty clearly, the leadership, things that are relatively outperforming are not what was outperforming, in 24 and early 25. And so I think this can go on a while. Like in the S&P 500, materials is 2%, And so a lot of portfolio managers say, well, why bother? It's only 2%. But if you have a real weight in materials, it's making a huge difference. We all are comfortable in Canada with financials because we didn't even get caught up in the financial crisis. But financials everywhere in the world are working. If you think about international stocks, Japan in 1990 was 45% of the total value of the world market. It's 5% today. So if you just go and buy the index, you're not necessarily getting to the right neighborhoods, especially in the S&P 500, because such a heavy tech weight that's relatively underperforming, and some of these other groups that are relatively outperforming, you want more exposure there.
I imagine that talking today about commodities outperforming tech, about international outperforming the US, it's a message that's absorbed a little easier because 2025 happened. And so people saw, okay, there is a world where other stuff can do better than tech. And tech wasn't awful. It just wasn't the best thing around compared to all the oxygen that it takes up. But you didn't just come around to this today or last year for that matter. This has been something that you've been working on for the last 2 years.
Right.
So take me back to that time, what you saw, because I think it would help people inform your approach when you're making these shifts in the market. And you're not a gold bug. You're not always in commodities. You can be very low in commodities. But what happened 2 years ago to make you shift? Because nobody 2 years ago was talking about this.
So really, this all started about 5 years ago. And it started really deep in COVID with the incredible stimulus that got thrown at the market and the liquidity that was created. And it was happening after 40 years of falling interest rates. So we got to where we should have been seeing a generational low in inflation, and then they just poured all this gas on the fire. And so when you go from a disinflationary environment to a reflationary or inflationary environment, it takes time for that to gestate, and it doesn't go from 0 to 100 all at once. But structurally, what benefits in long-term rising rates is very different than what benefits in long-term falling rates. You know, I was reading this morning on Bloomberg about all the gatings in the mortgage funds.
Yeah.
Well, you know, when interest rates are falling, the power's in the hands of the borrower. When interest rates are rising, long-term rates, 10-year, 30-year yields, the power's in the hands of the lender. And so banks are lenders, you know, and so these shifts take time, they get going, and then one by one, investors come around. When we started buying gold stocks 3 years ago, my young portfolio managers thought I had 3 heads. Because, you know, at 30 years old, they'd never seen a gold bull market. They'd only seen people lose money. And so I'm a macro investor. I come at it top down, and we're always watching the very long-term charts. And the US dollar started to top out in 2022 and has been weakening since then. And when the US dollar tops out, often international stocks start to wake up. Most international markets went nowhere from 2007 through 2021-22. Europe only woke up last year after not making a new high since 2007. When a big market makes a new high after 15 years, that's something to pay attention to, because now everybody's making money. There's nobody waiting for their price to get their money back. And then you can see new money get brought to bear, and it builds, and it can build for years.
I think that's so interesting that you had to convince the kids in your office. And in some ways, I feel like I'm a kid. And I've only, you know, I started covering the financial markets in 2008, 2009, but really not covering it since 2010. And everything has been pretty great since then. You know, we've had certain oopsie moments. And tech has been a big part of that for my portfolio, for my life. So how do you approach a conversation with someone like me who's only known tech outperformance and tell me, put it towards some of these rocks?
Yeah, it's a tough one. And so for me, you know, the way we approach things is that we look at, you know, like 300 universes of securities, like sectors and themes and geographic regions and asset classes. And what I've found is early in a new bull cycle, you'll see the percent of stocks performing well in that neighborhood start to expand. So there'll be 1 or 2 that have been outperforming. But then as things start to get better and money gets brought to bear, the breadth starts to expand. And so we try to be pretty agnostic to forecasting. We just try to really have tools to measure what is happening. And when we start to see some new strength in a group, we'll start with some partial positions.
Does this mean the Magnificent Seven is dead?
No, I don't think it does. You know, we own Google and we own NVIDIA and we own Broadcom. Those would be our 3 big tech weights. Oh, and we own Lam Research. But tech is like 11% of our firm assets, where it's, you know, 30% of the S&P 500. And it's because, isn't it great, there's an opportunity to diversify and make money in other sectors and not have all of our eggs in one basket.
So we're going to talk stock specifics. We've got a mailbag full of stocks. But because this is your view, and back in March, you were kind of insulated from the news. And that turned out to be the right thing, actually. You should have just earmuffed all the tariff anxiety, because if you just stayed invested, that was the right thing, even if you stayed invested in the US. So now, I mean, I don't even know how you capture the last week and a half in 2026. I'm just going to go around to some news items, and I want to hear how that influences, or not, your thinking. Maybe we'll kick it off with Venezuela. The fear for the markets, forget about the geopolitics of it, but the fear for the markets, specifically Canadian, is, wow, now we've got a real competitor when it comes to Canadian energy, and we're sort of toast.
Mm-hmm. You know, it is something certainly we have to think about. Having said that, Venezuelan oil is not exactly like Canadian Western Select, and it's not like our heavy oil. So that is something that could take place over time. Certainly into the Gulf refineries, that could have an impact. And we've seen the discount on Canadian heavy crude widen over the last week, so that's something to keep in mind. Having said that, we're in a commodity bull market, and the history is precious metals go first, base metals go second, energy goes third. And frankly, the Canadian big cap energy stocks are behaving a whole lot better than the crude price. So as a commodity investor, that's bullish. As a commodity investor, you always care, if the setup is good, the stock should start behaving better than the commodity itself. And the fact that they're not selling off shows you there is strength underlying in the market.
How do you, as somebody who's been in the market for decades, the word unprecedented almost has lost meaning because there's so many unprecedented things. We had over the weekend, U.S. Fed Chair Jerome Powell, in the most direct way possible, say, we are being threatened by the U.S. government to lower interest rates through potential criminal indictment, which is such an extreme thing. Even from the 70s, those conversations we used to have about government pressure on central bank policy. What does that do to your thesis?
I think the thing that it does for us is it's not for us to have an opinion whether something is right or wrong. It's what impact is it going to have in the market? And there has been this cumulative impact now globally of things that have happened that have caused international investors to say, maybe I don't want to have all my dollars within the reach of the U.S. Treasury. So central banks buying gold as opposed to treasury bonds. Gold is now a larger holding on central bank balance sheets than treasury bonds. That's as a result of all of these things. The push for easier policy, that feeds into the same story, So it helps you to understand why some of these sectors are doing well, because clearly, the push for Europe to spend more on defense, that's fiscal stimulus. The push for the Fed to give have lower interest rates, that's fiscally stimulative. The big beautiful bill, that's fiscally stimulative. So I don't know whether it's going to wind up being a problem for them or not. What I do know is it is helpful to some of the things that we're focused on, and we're trying to hedge against the risk that inflation sort of flares up.
Does that mean that the Sell America trade is alive in 2026?
I think if you're a Japanese pension fund and you spent 20 years buying US dollars because it was appreciating and using those dollars to buy treasury bonds and US stocks because they were performing and there was no local performance in your own market, and now your market is outperforming, the yen is kind of stabilizing, the bond market is offering a higher yield in JGBs than you can get in a treasury bond and then hedge currency, why wouldn't they consider bringing some of the money home, whether or not they agree with the guy that's in control in the US, and maybe they don't. Same thing for the Geneva pension fund or asset manager. They've held their nose and they own these great growth stocks, but they now have a choice. The local financial services industry is booming. Some of the defense stocks are performing really, really well. So it's not so much like for us to say we got to sell the US, but think about the motivations for other international investors. There's a motivation to rotate.
It reminds me of that acronym, there is no alternative. Tina, our friend Tina, and I feel like now Tina's gone away.
I think you're right.
Because there is an alternative. Talk to me about how all of this flows into gold, which is at records. Does each notch of uncertainty further embolden gold bullion?
Yeah, a lot of people used to say to me, well, the only reason you'd want to own gold is because there's some disaster coming. And okay, that's one reason, but it's a scarce asset and it's been money for thousands of years. So the truth is, there's lots of motivation. What I think makes this cycle so different, and we look at the cycle of the 2000 through 2011 or 1970 through 1980, both decades where gold had tremendous big runs. What makes this period different is all of the initial buying has been central banks, and they're not trading it. I think the average portfolio, as per Morgan Stanley's research, has between 2 and 3% precious metals in their portfolios. that will be 15 or 17% by the end of a bull market. And it doesn't mean there won't be corrections along the way. There will for sure. But it's not like this has become a speculative frenzy in private investors. It's been driven by central banks, and that's a bigger issue.
In addition to commodities outperforming, you were early on the financials trade, saying financials are going to outperform. Again, too, there are news-induced jitters about that. Could the president force a cap on things like credit cards and interest rates? Obviously, housing is something that he's very interested in, and it's trying to influence, actually, the mortgage rates, again, in an unprecedented way. But all of this, that like affordability is going to be very important in the U.S., especially as they're at a midterm elections. Talk to me about how you think about financials. Can you insulate from the news if you want to continue to own those? And do they still have leadership in your mind?
Yeah. So if you had to pick one sector that has the broadest bullish response in the market over the last 18 months, it's financials. Virtually 100% of financial services companies, banks in particular, globally, are trading above rising 200-day moving averages, which is long-term trend. And simply, we were at a point in 2020 where the short-term rate and the long-term rate were about the same. So how do you make a spread lending against that? And now we have the opposite. When the Fed cut rates last September, for the first time in 40 years, they cut the short-term rate and the 10-year yield and the 30-year yield went up. That was a signal. That's a change. And so if the power is in the hands of the lender, well, you better join them. Believe what's going on. And realistically, we've been long-term holders of JP Morgan as the leader. When banks went into their bear market, JP Morgan made a new high in 2013. It took the XLF ETF until 2021 to make a new high. That was the leader. But there's so many choices now in different parts of financials that there's a lot of interesting opportunity, even still to be diversified, but to be focusing in that sector because it benefits and will likely for the next decade.
Okay, well, that segues us perfectly into the mailbag. We're going to kick it off with some questions about banks.
Sure.
The mailbag is brought to you by BMO ETFs. If you're a do-it-yourself investor looking to take control of your portfolio, BMO ETFs makes it easy. Whether you're exploring stock replacement strategies or you want to find ETFs that hold your favorite companies, their tools are built to help you invest smarter. Check out the ETF Compare tool, the stock replacement tool, and news and insights under the tools section at bmoetfs.com. It's perfect for analyzing your options, spotting trends, and building a portfolio that fits your goals and timeline. Okay, our first question in the mailbag is actually about JP Morgan, which I know in the past had been a favorite of yours. Reporting this week, we're filming before results are out, so just full disclosure on that. But a tremendous run and kind of, I think of Jamie Dimon like America's sweetheart CEO. What is the catalyst right now for the banks? Like, how do you think about them? We're no longer worried about credit quality, and we're getting conflicting information in the U.S. about the strength of the economy.
Yeah, I think first off, market is telling us the economy is okay. The fact that transport's made a new high about a month ago, after not making a new high for 2 years, joining the strength in the Dow, that's telling you things are pretty good. Semiconductors behaving well, that tells you things are pretty good too. So I'm not so worried about the economy. If I think about JP Morgan, if you had to own one bank, that's the one you would own. It's the best run. They spend by far more money than any other bank on technology. And that's one of their secret weapons. Realistically, of all the industries, financial services is probably most likely to benefit from AI and be able to do more with less. So I think that's a big win for them. Second, there's been signaling from multiple banks. The expectation is investment banking is going to be a pretty good business to be in this upcoming year with the IPO market open and secondary financings coming. So that's a win as well. And then their net interest margins in general are getting better. So
this is the difference between what they pay in deposits and make on loans.
Exactly.
So now they can charge more on loans than what they have to pay out in deposits.
That's exactly right. We know when short-term rates are low, they don't pay as much on our deposits. But if long-term rates are higher, they can charge a higher rate on the loan and make more money. So,
and yet our deposits still remain the same.
Yeah, that's right. That's right.
Okay, so that's your U.S. bank pick, and it was actually a pick that you made in March too, and that's done really well since then, up 35%, but you continue to own it here. We got actually a couple questions about TD, which was obviously the comeback kid of 2025. It's up huge, 50% run up over the last year. James Gordon McLean and a few other people want to know, is it too good to be true? Do you just take your win and run? Do you still like TD?
Yeah. So I come back to the fact that the global banking industry now is in a bull market. And so even though the Canadian banks have outperformed over time, they've outperformed for good reason. When there's only 5 big ones, it's a pretty friendly environment for them to make money. TD's, making a comeback from a valuation perspective. They're getting a higher multiple as their problems are being distanced in the past. Their U.S. business is pretty good. So I think that you shouldn't second guess a bull market. The conditions that have caused it are still fairly early days. And one of our big themes is dividend growth. If you think long-term interest rates will work their way higher over the next 15 or 20 years, and the interest rates have a tendency to go in very long cycles, then that's a tailwind for the industry. And so we would encourage owning these things because they will continue to raise their dividends. And in the period from 1950 to 1981, where rates rose from 1.6 to eventually like in the high teens, banks were one of the greatest dividend growers there was. And dividend growth was the theme during that period. The Nifty 50 were all dividend growth stocks. So we're really high grading everything we do in the sectors we're focused on for the companies that have the best ability to raise their dividends.
And let's underline that because that has not been the key factor over the last 10, even 15 years.
That's right.
So it's another shift.
That's another shift. And you notice, if you look at any sector that tends to have high dividend payers but with low growth, they have underperformed serially since 2020.
Mm-hmm.
And what has outperformed is dividend growth. So you're getting lower dividend, but it's growing faster. And realistically, if you think about it logically, if you think you have a rising cost of living, having a rising stream of income is not a bad antidote.
I want to use this TD as a teachable moment because a lot of people look at the stock at all-time highs, record highs, and they think, well, now is a good time. I'm going to mark the top. I'm going to sell. You say respectable market. How do you know when it's over? How do you know when to get out?
It's a great question because even in a secular multi-year bull market, there would be corrections. So in our strategy, we use stop losses. And I do that not just because we're afraid of making a loss. I do it because if we have 20 positions in a portfolio, and we're fairly concentrated, 20 to 30 positions in a portfolio, realistically, if we're trying to find things that are good, getting better, that's our thesis. Sometimes if you take the 20, there will be 3 or 4 that work out way better than you ever expected. They're just getting better faster than you thought. Using a trailing stop loss lets you stay in them as long as they work. Mm-hmm. 7 or 8 will be pretty good and some won't work. So my premise is you got to cut your losers short, make little mistakes, not big ones, and hold the ones that win as long as they continue to win, because sometimes the story just continues to evolve. We've owned Fairfax Financial twice over time. Once, like 20 years ago, we owned it from $16 to $600. And we owned Fairfax Financial over the last 3 years, and it's been a tremendous winner. Mm-hmm. In both cases, it did much better than we expected. And so you need those 2 or 3 positions every year. And to sell your winning position generally means you cut out your opportunity for gain.
And we're going to talk about Fairfax. That was also one of your top ideas in March that performed really well. So let's put a pin in that. It's coming up later on in the show. Don't worry. I want to stick with our financials discussion. We started the U.S. We talked TD. We've also got a question on Banco Santander, Spanish bank. You like these international banks. It is making, the highest level since the financial crisis. And again, one of those stocks you talk about, just an absolute sort of dumpster fire for a decade, and then it woke up.
Yeah.
And you like to respect things that wake up.
Yeah, so Santander's, in disclosure, it's our largest position at the firm.
Oh, wow. When did you come to it?
About 18 months ago. And Santander is a really interesting bank. So it's the second largest European bank behind HSBC. But their platform is very, very strong in Latin America. So Spanish bank, Mexico, South America, consumer. So they've got a really great digital platform. So great technology. It's got a great balance sheet. Importantly, it's got growth, and it's really inexpensive. When we started buying it, I think it was 8 times earnings. Right now, it's 12 times earnings. To give you the comparison, Morgan Stanley trades at 17 times earnings. And European banks are outperforming U.S. banks. So there's a catch-up trade there. But at the same time, it's not just a catch-up. I mean, they are growing very, very nicely. So we think that with international money finding different locations, this is a winner. If we're in a commodity cycle, Latin America and South America should do quite well, and Santander can benefit from that.
I think it's also a good lesson. If you're a Canadian investor, you pretty much just look at the big 5. And if you want Latin American exposure, you would pick Scotia, because it has Latin American exposure. And over the past year, Scotia's done well. It's up 43%. Santander is up 132%. It's just, we have that home country bias. And I don't know, maybe you have thoughts on Scotia too, but it speaks to wake up to international markets.
I think we have to, because it's interesting. So when we started to see international markets wake up, international meaning everything ex-US, right? When we started to see things wake up, we started trying to decide how we were going to address it, because our focus really was more North America. And so we went looking at managers, outside managers. Funny thing is, so many of them had changed their mandates to global mandates because international didn't work for a decade. And so we wound up building our own fund, and it's gone well. But when you look at it, like for instance, Santander has had a 3-year compound annual growth rate in their dividend of 32%.
It's huge.
So, okay, it's a 2% yield. It's not a super high yield, but it's growing very quickly. And there's lots of opportunities out there internationally to find industrials and financials that are benefiting in this world.
Okay, well, let's see if we can find some. Our next sector, where we have a bunch of questions, all center around defense. We've got a question from Shaky Pudding. on
Great name.
Yeah, great name. Asking about names like Kratos, AVAV, any defense ETFs. I think defense is an interesting sector. Also Vulcan Dog asking, lots of great names because we take them from social media. Asking, so on one hand, I think Trump was kind of bullying some of these defense companies and saying, don't do buybacks. I'm watching your executive compensation. And then they were under pressure. But on the other hand, there's tremendous spend coming out of the U.S. and globally. What do you do with defense?
So look, defense has been one of our most important sectors over the last 3 years, actually 4 years. And we have to remember, the market is a machine. There's 1,000 moving parts. The news flow is really obvious, but there's so many other things that drive price. And of course, the biggest structural shift has been just increased defense spending everywhere in the world. And there's a couple of interesting attributes about defense stocks. In tech, for instance, everyone wants to tell you what's going to come next, what's going to be here next year, what's going to be here the year after. Defense companies don't do this. This is a skunk works. They have to keep a secret. When you buy a defense company, you buy what is there today, but there's all sorts of stuff in there that will be there that you're not paying for. So often there's a great pipeline of products. The second thing is the customers are pretty good at paying. They're governments, right? You don't have to worry about your receivables. And the pipeline generally is very deep. It goes years into the future. So we've been big investors in defense. The question was about Kratos and AVAV. Both of them sort of autonomous drone defense companies. Kratos makes engines for the hypersonic missiles, and they also make these unmanned aerial systems. And both have been good. They've been a little bit volatile, but they sure have a tailwind from the sector. We own Raytheon, we own General Dynamics, we own Howmet Aerospace, and we also own them through ETFs. Our macro strategy owns the ITA, which is the Aerospace and Defense ETF. PPA is another good one.
Okay.
But these companies have a tailwind, and then in Europe, European defense spending is going up a lot, and so EUAD is the ETF that owns the European defense stocks. And I think again, this is a structural change that's going to go on for a long time. You got to respect it.
I just want to use that as an example because there was a run up, then there was just a little bit of a wobble, like a multi-month wobble. And I think people who invest in momentum names like you do, they think a wobble can turn into something a lot more severe. So did you guys end up selling? No, because it didn't hit your stops.
No. So, everybody has their own ways of doing things. Some people use a moving average as like a 50-day moving average or a 200-day moving average. We are longer-term investors. We're not traders. I use point-and-figure price charts. They're an old-fashioned tool invented by Charles Dow way back. But they help to recognize inflection points. An uptrend is higher highs and higher lows, and a point-and-figure price chart identifies clear points where something goes from higher highs and higher lows to lower lows and lower highs, and that's where we use our stocks.
Is that proprietary or like?
No, it's a tool. I think they're very good because they're not subjective. And there's an excellent book by a fellow named Tom Dorsey, How to Point and Figure Charting. And I used these tools for 30 years.
Okay, I like that. I'm sure there's a lot of people that are going to be looking up that book. Okay, we've got industrials, another sector that you liked. Not all industrials have done well. We've got a question on the rails, CP and CN rail.
It's interesting. So I mentioned earlier the transports are waking up. It has been primarily the logistics companies that are doing better. Like an Expeditors International.
Or FedEx.
FedEx. The rails have still been tricky. So, I watch them very closely. It's an important sector, especially in Canada, CP and CN. Neither of the charts look very good.
Ugh, I own CN, waiting for it to wake up.
Yeah. If I had to make a choice, frankly, CP is the most logical because of their north-south straight through to Mexico, single line railroad. It's very efficient. Both the Canadian railroads are very efficient and are able to continue to improve their operating ratios, their costs versus the revenues. But we need to see the charts get better before we put money to work there.
Okay. Call me when they get better. We got a question on Aecon, construction in Canada. I'd love to know what you did with a chart like that. Huge momentum going into 2025, completely falls out of bed, and then a huge rally again.
Yeah, so we don't have any current exposure. We owned WSP.
Oh yeah, that's a good one.
And this whole group did go through a pretty significant correction, and we did come out of them. The thing you have to, I think, get your head around is it's okay to sell something and come back if the fundamental story stays good and the technical picture improves. So we did come out of Fairfax, going back to the insurance companies, in the summer, and we actually have put the position back on because all of the insurance stocks corrected, and then one by one they started to sort themselves. I think that realistically, again, the spending on infrastructure and the engineering around basic materials, mining is going to be strong. I think this is a sector you have to be looking at.
There's a question on TFI trucking, and you mentioned the logistics players are perking up. Again, like kind of an ugly chart, really fell out of bed before the tariffs.
Yeah.
And then stagnated and then recently has lifted, but is nowhere back to where it was in 2024.
Yeah, I think you have to give that some space. It's trading below the 200-day moving average. You know, think of it this way. There's an army of people who bought it in 24 and early 25 who are underwater. One of the reasons we like to buy stocks that are trading at new highs is because every shareholder is happy. There's no built-in sellers. When you buy something that's had a bad correction, you've got to work your way through all those folks who are just waiting for their price to get their money back. If you only need 20 or 30 positions in a portfolio, you don't need to be fighting that tide.
This is like therapy for me because I love a broken chart. And one of the things I don't know if it was a New Year's resolution, but in 2025, I've said to myself, stop being afraid of buying things at record highs.
Yeah. I mean, if you're in a structural theme, you know, every new dollar is a new high. And so, you know, it's our premise. You want to buy strong fundamental companies that have a catalyst for change. That means it's getting better. And with a price chart that supports your view. Because if it doesn't support your view, it may be that you're missing something. Yeah. That other folks have figured out.
Yes.
And it's a rotten feeling to figure that out too late.
Google was an example.
Yeah.
Right? So, and I was a loser and I sold it. Everybody knows that. But you owned it. And so what everybody felt like they wrote off Google.
Yeah.
Why didn't you write off Google? The chart should have told you to write off Google.
Yeah. So in fairness, again, we came out of the stock in the spring of this year. Late fall last year. Mm-hmm. But as it traded back above the 200-day moving average, and as the picture got better, you had lots of time. Now, of course, this has been an absolute rip-roaring bull market in Google shares, especially against the Mag 7.
Yeah.
You know, but look, I mean, if I think about all the times I've owned Apple over time, mm-hmm. we've owned them for periods of time and we've come out of it. We've owned it and we've come out of it. You have to justify the near term versus the long term. And that's one of the hard things about investing. You have to be mentally flexible.
So let's apply that to healthcare. We've done healthcare. I think healthcare is such a fascinating sector. There's so much going on. There's innovation, there's drama, there's politics. In our healthcare episodes, like nobody cares about that. And I'm just thinking this is like a sector that's just cut adrift. And then we walk into 2026. What's one of the best performing sectors? One of the best performing stocks, for goodness sakes, is Moderna.
Yeah.
So is this a sector that's waking up?
It's a great question. Certainly, the healthcare sector started to improve in the early fall. And biotech in particular, if you look at the XBI, which is the equally weighted biotech index, you know, it's performed remarkably well. So it showed strength right away. Our approach to that is let's buy the leader. We'll start with a partial position. So in our opinion, Lilly is one of those positions.
Great. That's mine too.
and I think if I look at it today, okay, yes, the sector's getting better. The chart on Lilly is fabulous. And the growth opportunity they have, I think, is significant. And so, you know, it's an obvious sort of good getting better story. And so that's what we look for. Intuitive Surgical, which we don't own, looks similar and is behaving very well. And Moderna is a different kind of a chart. I actually own it as a pro investment, but it's more, it went through a basing process and has made the turn. So there are opportunities there. And again, I don't think it is the sector to be focused in, but it's a sector to be focused in. And we'll see. If it builds, then maybe we start adding more positions.
All right. Lilly did work out buying the dip, but I did have to be patient on that one. Okay, let's do a few commodity ones. I'm not going to spend too much time on that because most of your top ideas are commodities. Yeah. But I actually bought this one. So I did want to have a follow-up question on Alamos Gold.
Yeah.
Do you still like it? You made a real compelling case to buy Alamos. And it convinced me. I think maybe did it convince $1 million? No, you didn't convince $1 million. But let's see if we can convince him now. Do you still like Alamos?
Yes, we do. We own Alamos. In a commodity bull market, you want to own some very high quality senior producers. and then you want to own some growth opportunities. And what I like about Alamos is it's in friendly jurisdictions, most important, right? Most important. They have multiple mines. That's also important. And then, it's the growth opportunity going forward.
What's interesting about Alamos, and I know because I was watching it for the months after, I'm like, it's not doing anything. It took a while.
It did take a while.
Like compared to the gold price was moving.
Yeah.
But Alamos wasn't.
Well, a lot of the smaller companies were not for a while. I mean, one of the things, I spend a lot of time on Twitter.
Yeah.
At Barometer CA. And the truth is, when you're interested in something, of course, the algorithm continues to feed you things. And I watched no end of people complain about the fact that gold was performing well, and why aren't the stocks doing well? Well, the large caps like Agnico, and for instance, was doing great. But it took a while for these to get going. I think the opportunity is that we are going to continue to see mergers and acquisitions. And so Alamos is one that's just growing organically. It's gonna do well on its own, but you never know. You could wake up on a Tuesday morning and it winds up getting acquired by somebody. And it's just one of those intermediate tier stocks that we wanted to have position in.
So speaking of M&A, do you have thoughts on the rumor of Glencore taking a run at Rio Tinto?
Yeah, I think that's something that has been sort of an on-again, off-again conversation. And, there have been lots of attempts by all of the major base metals companies to protect themselves, to become more pure copper players. And this would be an interesting one. The situation with Teck Resources, also, played into that. I think it's very possible.
What's funny is when I saw the price tag, or like the size of the company, the combined company being the biggest ever, the market cap was $200 billion, which sounds like a big number, but is actually like cute compared to $4 trillion, which is what NVIDIA is.
Look, I'll go out on a limb, and there will be corrections, but I think that a lot of these companies over the next many years are going to be 5 and 10 baggers.
Wow.
So this sector will wind up being sort of 15% or 17% of the market if we have the kind of structural bull market it looks like we're going to have. And right now, it's obviously a much smaller piece. So markets are amorphous, they ebb and flow, and this is a sector that I think is going to be under accumulation for a long time.
Okay, well, let's see if we can find some of those 5 and 10 bankers and take a look at your pro picks.
Yeah.
ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, before we get to your top ideas, I want to revisit your past ones. JP Morgan, Fairfax Financial, Agnico Eagle, all have done tremendously well since you were on March 6th. Your average return is up 53%. So that has definitely outperformed the market. JP Morgan, you touched on, you still like. Respect Financials, JP Morgan is the best house in a good neighborhood. Fairfax, you did touch on a couple of times, but I want to expand on that. We get a lot of questions about why Fairfax isn't more widely held. Probably every Canadian fund manager will own Royal or something like that. And like Fairfax, has it not earned that position in fund managers' books?
Yeah, it's just not that liquid. I think that's the biggest issue. And it's a little more opaque because of all of their investments in privates. And so it's a little harder to understand. But there are some real disciples. Fairfax has outperformed Berkshire over time. And a lot of people don't realize that. So they have just been very, very effective at making good decisions when it comes to their investments over time. And as Warren Buffett has shown, this property and casualty business is a pretty good business. you're basically managing the float if you can make good investment decisions.
So you continue to like it here.
We do.
Your third one, home run, 95% return. That's Agnico Eagle. This maybe is a good opportunity and time to talk about most people, if they owned gold, you've doubled your money in a year. Again, that can feel uncomfortable to make so much money in a short period of time.
Yeah, and I understand that. I mean, the reason they're called cyclicals is they do bounce around. There will be a correction at some point over the next few months that will be hard to stomach. You know, these will correct 30% at some point. If you look at the bull market of the 1970s, there were 3 very distinct legs in the bull market, interrupted for several months at a time, a couple of times. So we are now, way above the moving averages, but you can't sell something because it's overbought in a bull market. So you have to have your own strategy, and we'll use our stops. So I think if you're looking out over the next 7 or 8 years, what started 18 months ago will wind up being 10 baggers. And so we'll see. Agnico is just the institutional favorite, and it's the best managed, and they have done the best job at not making mistakes operationally, and they've got a good growth profile. So it's one that I think an investor can live with a little more volatility and knowing they got a great balance sheet. It's a dividend grower, like we talked about earlier, and it's a multi-mine company in safe jurisdictions.
Let's go to your top ideas now, all mining focused, but maybe a little bit smaller cap. Maybe we can take those risks in this market where things are starting to broaden out. Hudbay Minerals is your first idea in copper. And we haven't talked too much about the fundamentals of copper, so I'd love your perspective on that.
So we are going to be in a deficit of supply in copper, given all the things that are happening in the world, AI and energy transition and so on. The interesting thing about commodities, and the reason they have long-term bull markets, is because when they go out of favor, boards of directors get put in place to make sure the CEO doesn't spend any more money to get them through what is a bear market. What it means is by the time you wind up with firmer prices, there's no new production coming on. And so copper, like some other commodities, went kind of like 10 years with only a couple of big new projects coming on, and tech, of course, had one of them. So now we're facing what will likely be a deficit in production. And so we want to own things that are going to benefit from that. Hudbay has really good growth opportunity with their Copper World mine. And it's been de-risked. Mitsubishi just announced they've come in and they're funding the rest of the development, $400 million. And so now Hudbay can focus on the cash flow that will generate from this. And so the history is that precious metals perform well first in a secular bull market. Then the copper stocks and base metals companies join in. Of course, we're seeing that. And so, again, don't be afraid of the fact that they've had this great lift because it could go on for a long time. And then the last thing is, of course, as an intermediate-sized company, Mitsubishi may at some point decide they really have to own the rest of it. And that would have to come at a pretty good premium.
So a takeout as an option, free option, but not necessarily.
Yeah, we don't own it because of that, but those are the types of things that happen to mid-sized producers.
Okay, let's move to another metal, precious metals. Your idea as a streamer, Wheaton Precious Metals. Yeah. Why take this approach? I guess you have mining exposure.
Yeah.
So what does streaming get you?
So one of the things that we're thinking about is, what will happen when we do see a correction. And so the streamers in general will have less volatility. Wheaton is the most exposed of the streamers to silver, more than Franco, for instance. And they have a higher growth in production. And so they have more growth in their revenues. So of those two, Wheaton is the one that we would focus on. For the investor that doesn't have exposure to precious metals, and there's tons of them. I mean, I talked to a very senior investment advisor yesterday by happenstance, and he said, do I really need to have some of this in the portfolio? Because it's just not something I focused on. I said, well, it's a good choice. There may be a better moment at some point over the next few months to do it. I don't know when we'll get a correction. But yeah, you sort of do have to. We look at precious metals right now as the alternative to bonds. I mean,
like when you say precious metals, are you talking gold or are you talking silver too?
Okay, gold and silver and the producers are the hedge against inflation. Bonds are a hedge against disinflation. So we've thought for 40 years bonds are the safe asset because interest rates were falling and there was risk of falling prices. I would say the big risk today is inflation and the loss of purchasing power. So actually, gold is less volatile than a treasury bond for the first time in 45 years.
How do you measure that?
For one volatility versus the other.
Okay.
And it's been that way for about 12 months. So we think one of the most important hedges for investors is to hedge their risk against inflation. Dividend growth is one way, financials are another way, precious metals are another way. It can move around day to day, but I think the long-term trend is higher.
I want to spend a beat on silver because we've talked about gold and all the reasons you're optimistic there. Silver is a little bit more of a spicier metal. It can move swiftly up and it can be a heartbreaker. And right now we've seen a parabolic move in silver. What do you do with parabolic moves? Because you like momentum. Do you like when things go this bananas?
As a momentum investor, you have to embrace it. And you just have to have discipline around your exit. So everybody can find their own way. And yes, it is sort of going parabolic as it is right now. Stanley Druckenmiller would say, if you find a bubble, lean into it to take advantage of it. And you just have to be disciplined around it.
Can we talk about that discipline in terms of percent corrections? Like, are you afraid of 20%?
I think you have to, in a bull market, you have to be willing to accept a little bit more volatility because there's more upside. But yes, we'll follow our positions with trailing stops. But the reason I talk about Wheaton is because if someone's a longer term investor, they can stand a little volatility knowing that this has got such a great balance sheet and such great dividend growth and such a broad asset base that it's going to be around and it's going to continue to thrive.
Okay, your final one is actually an energy pick, and it's Headwater Exploration. And I'm curious why you like this name. We've actually been hearing a lot about it from some of our energy-focused guests saying, look at the Clearwater play.
Yeah.
Everybody's focused on what CNQ is up to, what Suncor is up to. Look at these headwaters, these tamaracks, because that's where growth is. What brought you to Headwater?
Well, you just named 4 of our positions. Okay. First, I started out with the backdrop that energy is likely to join this bull market. Second, there are some companies in this sector in Canada that have gone through major transitions, are very, very strong from a balance sheet perspective, have very low costs, and are showing themselves in the market. So yes, if you look at the XOP, which is the U.S. Producers ETF, doesn't look that great. And if you look at oil price, doesn't look that great. So why is Headwater, trading near new highs? The fact is they have incredibly low costs. The Clearwater is a very productive play. And in their case, they're using multilateral drilling and they have very low decline rates. So like 20 to 25% corporately, which is really, really good. They're using water flood to optimize their production. And they have a break even of like $35 a barrel. So when we enter a sector that maybe is early, we want to make sure that we're not dependent on it getting better for us to make money. We want to know we're making money already. So I think 2026 could wind up being a year where energy catches more of a bid. And we want to start with the strongest companies we can find, technically and fundamentally. This company has a great balance sheet. They've got low cost, operationally strong.
Do you own Tamarack too?
We own Tamarack as well.
Okay, another Clearwater play. You did say that I mentioned some of your other holdings, Suncor and CNQ, and I want to spend a beat on CNQ because everybody asks why it's underperforming. And one of the questions has come about return of capital to shareholders because they've got some spending. And so one of your theses is you have to be a dividend grower. I think there's anxiety about CNQ's ability to be that. So where's your conviction on CNQ?
So CNQ is incredibly well managed. They have incredibly good long-lived assets. They also have a huge, natural gas base, which is sort of an option. Somebody said to me one time, a very smart energy investor said, think about an energy company as an option. You don't know when the price is going to rise on the commodity, but what you're buying is what's in the ground and their ability then to sell into those rising prices. And CNQ is a perfect example of that great optionality. Yes, they have a history of capital spending to grow, but they grew because of it. So you can't really penalize them for that. We are in an era where these companies are likely to be huge cash flow generators and great dividend growth stocks. I don't think that the fact that they're spending money to grow means they won't grow their dividend as well. Capital return is going to continue to be an important part of their culture. Are
you violating your own practices by owning CNQ? Just because looking at the chart, it's a really muddling along chart.
If you pull the lens back.
Yeah, longer term is much better.
Take to like a monthly chart.
Okay.
First of all, it's trading above 50-day. It's trading above the 200-day moving average. It's not a problem there. A 50-week and 200-week. But if you look at the very long-term picture going back, it was in a bear market from 2008, where it topped out around $34, and finally traded through into a new bull market in the beginning of 2021. So in the last bull market, stock went up about 700%. That was between 2001 and 2008. Stock has corrected and consolidated. The long-term picture is very bullish.
David, what a pleasure. Thank you so much for joining me. The audience would have killed me if I didn't ask you about CNQ, so I had to squeeze that one out there. But thanks so much for your insights and your ideas today. It
was really fun being here.
All right. Make sure you tune into our next episode. We've got Chadwick Westlake. He is the new CEO of EQB. This is one of the smaller Canadian banks and has the crown of being one of the worst performing in 2025. Those tend to be the best performing the following year. We'll see if EQB has got the strategy in place to become a winner this year. We'll get perspective from the CEO who came in during difficult times after the sudden death of Andrew Moore, who was the CEO. So we'll talk about all of this. Don't miss that episode next week.